Welcome to Islamic Finance for everyone. Are you curious about a different way of managing money? In this series, we'll explore the fascinating world of Islamic finance in a clear and accessible way. Whether you're a seasoned investor, a student, or just someone curious about the world, we're here to demystify this important field.
Assalamu alaikum warahmatullahi wabarakatuh everyone, and welcome to the second episode of Islamic Finance for Everyone. I am edibsmolo and I'm passionate about making Islamic finance understandable for everyone. I work in the industry for several years and have seen firsthand how these principles can benefit individuals and communities. Many people hear the term Islamic finance and think it's complicated or only for certain people. That's simply not true. It's based on the principles that are rooted in fairness and ethical conduct, principles that can benefit everyone.
The story of Islamic finance is a compelling one. While its roots go back centuries, its modern form began in the mid-20th century. Since then, it has blossomed into a global industry, spanning continents and impacting millions of lives.
The modern Islamic finance industry emerged in the mid-20th century with pioneering initiatives like the Mudarabah saving bank in Egypt in the 1960s. These early experiments demonstrated the viability of interest-free financial transactions. Industry experienced significant growth, particularly after the establishment of the Islamic Development Bank in 1975. The global financial crisis of 2008 further highlighted the potential of Islamic finance as a more resilient alternative to conventional finance. While Islamic finance was not entirely immune to the crisis, its principles of risk-sharing and asset-backed financing provided a degree of stability. Today, the industry encompasses a wide range of financial products and services, with assets under management reaching trillions of dollars globally.
So, what exactly is Islamic finance? It's a system guided by Sharia principles, which are derived from the Quran and the Sunnah, the teachings and practices of Prophet Muhammad, peace be upon him. These principles promote fairness, ethical conduct, and shared risk.
Many authors have discussed the fundamental principles of Islamic finance, which are primarily derived from the Quran, Sunnah of the Prophet ﷺ, peace be upon him, ijma or consensus of ulama, and qiyas or analogy. The most important principles are: 1. Prohibition of interest, riba or usury. The payment and receipt of interest, riba, are strictly prohibited in Islam. The Quran states,
الذين يأكلون الربا لا يقومون إلا كما يقوم الذي يتخبطه الشيطان من المس ذلك بأنهم قالوا إنما البيع مثل الربا وأحل الله البيع وحرم الربا.
The literal meaning of riba is excess, growth, or increase. Technically, it refers to a predetermined extra amount charged by the lender over the principal amount. Sheikh Usmani defines interest as any additional amount charged from the debtor. Classical Islamic jurisprudence or fiqh recognizes two main types of riba. 1. Riba al-nasi'ah or interest on loans, also known as riba al-jahiliyyah, pre-Islamic interest, or riba al-duyun, interest on debt. This refers to the extra amount a debtor must pay due to a delay in repayment. It is explicitly prohibited in the Quran. Second type is riba al-fadl or riba interest in exchange. This type of riba is prohibited by the hadith of the Prophet Muhammad ﷺ, peace be upon him, and refers to the unequal exchanges in a trade, such as selling goods of the same type but in unequal quantities without a valid reason. Second principle is the prohibition of excessive risk and uncertainty, or gharar. Literally, gharar refers to something that appears pleasant but has an unpleasant reality. In Islamic finance, gharar is defined as the sale of items whose existence or characteristics are uncertain, making the transaction akin to gambling. Examples include selling fish in the sea, birds in the sky, or unripe fruit on a tree, which involve excessive risk and uncertainty. Next principle is prohibition of the gambling and speculation, or maysir, or qimar. Islam prohibits gambling and games of chance where one party stands to lose everything. These are zero-sum games that transfer wealth from one party to another without creating new value. One reason for this prohibition is that maysir fosters hostility and distracts believers from worshipping Allah subhanahu wa ta'ala. Next principle is Sharia-compliant activities. Islamic financial institutions can only engage in or finance activities that align with the Sharia principles. As a result, financing casinos, tobacco, alcohol, pork, pornography, and weapons, among other things, is strictly prohibited. Next principle is the principles of risk and profit sharing. While Sharia prohibits earning income through interest, it allows generating income through risk and profit sharing arrangements between parties. In other words, Islam encourages entrepreneurship that builds trust and cooperation between partners. In Islamic finance, both the financier and the entrepreneur share in the risk and reward of a venture. This contrasts with conventional finance, where the lender typically bears the little risk while receiving a fixed return. Next principle is sanctity of contracts. Fulfilling contractual obligation is considered a sacred duty in Islam. Full transparency is required during the agreement to reduce the risk of asymmetric information and moral hazard. Next one is the social justice. Finally, Islamic finance promotes social justice through mechanisms like zakat, charity, and encouragement of ethical business practices. Islam prohibits any transactions that leads to injustice or exploitation. Moreover, Islam prioritizes public interest, known as maslaha, over individual interest.
These principles form the foundation of Islamic finance, ensuring fairness, transparency, and ethical practices in all financial transactions. By adhering to these principles, Islamic finance promotes a just and equitable financial system that benefits everyone.
Now, let's look at some practical examples of Islamic financial products. These are the tools that individuals and businesses use every day. The range of Islamic financial instruments has expanded significantly since the establishment of the first Islamic financial institution. Today, these instruments are used across various sectors, including housing project, car financing, equipment financing, business projects, and even government deficits. Let's explore some of the most common Islamic finance instruments. Qard al-Hasan, or benevolent loan, literally meaning good loan. This is a contract where one party lends money to another as a form of social assistance. The repayment amount must equal the borrowed amount. However, the borrower may voluntarily pay more as a gesture of goodwill, provided this is not stipulated in the contract. Murabaha, or cost plus financing. This refers to a sale contract where the cost and profit margin markup are disclosed to the buyer, client. The bank purchases the asset required by the client and sells it to them at an agreed upon price, which includes the profit margin. The sale price is determined upfront and cannot be changed after the contract is signed. Ijara, or leasing. Literally, it means to give something on lease. This is a contract where the lessor, in which case bank or owner, leases an asset to the lessee for a predetermined rental fee over a specified period. Ownership of the leased asset remains with the lessor, who is also responsible for its maintenance. Another type of ijara is ijara wa iqtina, or lease to own. Similar to ijara, but with one key difference. At the end of the contract, ownership of the leased asset is transferred to the lessee. This transfer occurs through a new contract, where the asset is either gifted or sold to the lessee at a nominal price. Next type is a salam, or advance payment. This is a sale contract where the price is paid upfront, but the delivery of the purchased goods is deferred to a future date. This is commonly used in agricultural financing. Next type is istisna, or manufacturing contract. It is a sale contract where the buyer requests seller to deliver a finished asset in the future according to the specification outlined in the contract. This is often used for construction projects. Mudarabah, or passive partnership. A partnership between the capital provider known as Rabbul Mal and the entrepreneur or manager known as Mudarib. The capital provider contributes the funds while the entrepreneur manages the businesses. Profits are shared according to a pre-agreed ratio, but losses are borne solely by the capital provider, who has no right to manage the business. Next type is musharaka, or active partnership. Literal meaning is the sharing. This is a partnership where two or more parties contribute capital either in cash or in kind and share profits and losses. It is similar to a joint venture arrangement. Musharaka mutanakisa, or diminishing partnership, is a type of hybrid financing technique combining musharaka and ijara. In this contract, the financier, bank, and the client jointly own an asset or property, with the financier gradually selling their shares to the client at an agreed price and schedule. Last but not the least is the Sukuk, or Islamic bonds. These are the certificates or documents representing ownership in tangible asset, project, or investment activity. They're similar to conventional bonds. Sukuk can be traded on the stock exchange market, about which we will be discussed more later on. However, they are asset-backed and structured in compliance with Sharia principles.
These instruments form the backbone of Islamic finance, offering ethical and Sharia-compliant alternatives to conventional financial products. By adhering to principles of fairness, transparency, and risk-sharing, Islamic finance promotes a more equitable and sustainable financial system. If you found this explanation helpful, don't forget to like, subscribe, and share this video with your network. Let's spread the word about ethical and inclusive finance. Follow us on social media platforms for more insights into Islamic finance.
The Islamic finance industry has experienced remarkable growth in recent decades. According to some leading reports by IFSB and other institutions, the total assets of the Islamic finance industry are estimated to be over $4.5 trillion worth of assets in 2022, which represents a 17% increase from 2021. This growth reflects the increasing demand for financial products and services that comply with the Sharia principles. Islamic finance has the potential to contribute to greater financial inclusion, particularly in the Muslim-majority countries. It can also play a role in promoting sustainable development by encouraging investments in ethical and socially responsible projects. So, that was a brief introduction to Islamic finance. We just scratched the surface, but I hope you now have a better understanding of what it is and why it matters. In the next video, we'll delve into the history and development of this fascinating field. Don't forget to subscribe to the channel for more videos like this. Like this video if you found it helpful and share it with your friends and family. Also, follow us on social media for more updates and discussion. Assalamu alaikum wa rahmatullahi wa barakatuh.
A special thanks to all those who are supporting the IFE project directly and indirectly. Stay tuned for more insightful videos on Islamic finance.